This is Mastering Covered Call Writing, the covered straddle strategy. A covered straddle is an interesting variation on the covered call. In this strategy, you own 100 shares of stock and then sell both a call option and a put option at the same strike price and expiration. The stock position offsets the short call, while the short put remains uncovered. In this video, we'll look at how the covered straddle is structured, compare its risk and reward to a standard covered call, and explore why it's often described as the equivalent of either a 200-share covered call or the sale of two uncovered puts. Along the way, I'll show you profit and loss diagrams so you can see how these relationships play out in practice. Let's review what a straddle is. A straddle involves selling both a call and a put option at the same strike price and expiration date. If the stock stays stable, both options lose value and the seller keeps the premium. If the stock makes a large move in either direction, losses can grow quickly. When sold without any stock position, this is called a naked short straddle. It carries unlimited upside risk from the call and significant downside risk from the put. So what makes a straddle covered? A covered straddle adds stock ownership into the position, so you are long 100 shares of stock, short one call option, and short one put option. The stock covers the short call, similar to a covered call strategy. The put, however, remains uncovered. So in reality, the structure is only partially covered. Let's hop into the tastytrade platform here to demonstrate setting up a covered straddle trade. We're in the queues here, and I'm going to open up the October 17th, 2025 options expiry. These options expire in 43 days, and I'm going to populate purchasing 100 shares of QQQ while simultaneously selling a 570 strike straddle. And when I populate the order ticket here, we can see that we're bringing in $2,700 of extrinsic value. The delta is close to 98, theta is around 31. The max profit is just over $2,800. Max loss is just over $111,000. And this is going to deduct my margin account buying power by a little over $38,000. When I go into the analysis tab to take a look at the profit and loss diagram at expiration, we note that the center row here represents the value of QQQ in the graph. And the row at the top that I'm highlighting represents the P&L at expiration, and it's a numerical value to match the graph below. And we can see here that the covered straddle position makes money up until just beyond the strike price of the straddle, after which gains are capped at $2,800. We can see here that the break even is around $555, and as prices drop below that level, the overall position loses, with max loss capped as QQQ were to approach zero. Over the course of the next few slides, we're going to calculate max profit, max loss, and the break-even points for the covered straddle. We need to know stock price at entry, strike price, call premium, put premium, and the total premium collected for selling the straddle. Max profit occurs if the stock finishes at or above the strike price at expiration. It's calculated by taking the strike price minus the stock price at entry and adding the premium collected for selling the straddle. Max loss occurs if the underlying stock falls all the way to zero and is calculated by taking the stock price at entry plus the strike price and subtracting the premium collected for selling the straddle. Break-even price is the stock price where your profit and loss is exactly zero and is calculated by taking the stock price at entry and adding the strike price, subtracting the premium collected from selling the straddle from that value, and taking all of that and dividing it by 2. It's important to note that these formulas represent owning 100 shares and selling one straddle. You'll need to adjust the number of contracts that you're trading in the formula in order to get accurate numbers. Now let's talk about synthetic equivalencies. We know that a covered call position represents owning 100 shares of stock and being short one call against those shares. We also know that an uncovered short put position is synthetically equivalent to a covered call. And if you need a refresher on this, please see Introducing Synthetics, Selling Puts versus Covered Calls. In this video, we go over in detail how a short put position is synthetically equivalent to a covered call position. When you own 100 shares and sell one put and one call, in other words, sell a straddle, you've combined a covered call plus another synthetic covered call. That means the covered straddle can be viewed in two different but valid ways. First, it can be viewed as a synthetic equivalent to a 200 share covered call right, or it can be viewed as a synthetic equivalent to the sale of two uncovered short puts. Let's demonstrate this in the tastytrade platform. I have QQQ populated in the trade tab, and we're going to open up the October 17th, 2025 expiration cycle. And I'm going to populate the covered straddle trade. So I have 100 shares of QQQ populated in the trade tab, and I'm going to sell the at the money straddle. The strike price is at 572. And we can see that we're collecting $2,600 in extrinsic value. We have 99 delta, 31 theta, max profit of just under $2,800, a max loss of $111,000, and a buying power effect of just over $38,000. And when we take a look at the profit and loss diagram in the analysis software, we can see that the position profits up until the point of the strike price of the straddle, after which the position has reached max profit, and losses accumulate beyond the break-even point as QQQ approaches zero. Now let's compare that position to selling two covered calls. I'm going to populate purchasing 200 shares of QQQ in the trade ticket, and we're going to turn around and sell two of the 572 strike call options against those 200 shares. And we can see here that we're bringing in just over $2,800 in extrinsic value. Delta is close to 99. Theta is about 33. Max profit is just over $2,900. Max loss is just over $111,000. And this would result in a debit of $54,000 in the margin account. And when I bring up the profit and loss diagram at expiration in the analysis tab, we can see that this diagram looks almost identical to the previous example. Now let's look at the synthetic equivalent of two short puts. We're going to open up the same expiration cycle. We're going to use the same strike price of $572. And we're going to populate selling two uncovered puts at that strike price. We're bringing in extrinsic value of just over $2,400. Delta is close to 98. Theta is around 28. The max profit is just over $2,400. Max loss is just over $111,000. And this time the buying power effect is only $22,877. And when I bring up the profit and loss diagram here, once again, we can see that it is nearly identical to the two previous positions. This time, max profit is around $2,400. And we can see that losses accumulate once the position drops below break even. So I took a screenshot of each of the three positions we just reviewed so that you can take a look at just how similar they really are. The top screenshot represents the covered straddle position, while the middle screenshot represents the 200 share covered call position. And finally, the bottom screenshot represents the short put position. And we can see that all the positions have very similar max profit and max loss values. The only difference is the buying power effect. And of course, the buying power effect will matter in margin accounts and will be somewhat irrelevant in cash accounts. It's important to consider the Greeks of a covered straddle position. First, let's talk about delta as it relates to the short straddle. A short straddle has a delta that changes depending on where the stock is relative to the strike price. At initiation, assuming a trader sells an at-the-money straddle, the short straddle has a neutral delta of around 0. If the stock rises above the strike, the short call becomes more in the money, and the short put becomes more out of the money. And the net effect is that the straddle becomes net short delta as the call begins to dominate the position. If the stock falls below the strike price, the short put moves in the money, and the short call moves out of the money, and the net effect is that the straddle becomes net long delta as the put dominates. A short straddle's delta is dynamic. It flips signs depending on stock movement. Now let's talk about stock position delta. In a covered straddle, you also own 100 shares of stock per contract. Long stock has positive 1 delta per share, so with 100 shares, that's positive 100 static delta. This part of the position does not change with price. It's always positive 100. So the key takeaway is that the stock's delta is fixed, while the short straddles delta is variable and flips with price moves. As a result, the overall position delta will vary based on the underlying stock price. And in the case of being long 100 shares and short one straddle, the delta will stay in the range of being 0 to positive 200. Now let's talk about the rest of the Greeks. Theta, both the short call and short put, generate positive theta. This strategy collects time decay, especially when the stock stays near the strike price as expiration nears. Next is vega. Both the short options are short vega. This means that the overall position benefits from a drop in implied volatility and loses value if implied volatility rises. And finally, let's talk about gamma. The position has negative gamma, which means losses can grow quickly if the stock makes a large move to the downside because the long shares and short put option are not covered. Now let's talk about a tweak that some traders like to add at initiation. Traders sometimes choose to reshape the risk at entry by adding an out-of-the-money put option. Buying an out-of-the-money put option caps the downside risk while still collecting premium from the straddle. This adjustment reduces net premium but creates a more defined risk profile. So let's take a look at what a trade like this would look like in the Tasty Trade platform. I have the cues populated in the Trade tab. And we're going to open up the October 17th, 2025 options expiration cycle. And let's quickly calculate the downside break even for the at-the-money straddle. And I do this by taking the strike price of the straddle and subtracting the credit received for selling the straddle. And that gives us a downside break even of $545 per share. Now let's populate the trade. We're going to purchase 100 shares of Q at the current market price. We're going to sell an at-the-money straddle, which happens to be the 573 strike straddle. And we're going to scroll down and purchase the 545 strike put just to cap our downside on that straddle position. We're going to go to the Analysis tab to take a look at what the overall P&L graph would look like at expiration. We can see that the potential trade is populated here. And there I'm adding the 545 strike put option. I'm going to minimize that column. And let's take a look at what this trade would look like in the graph. So we can see here that the trade would be profitable up until the point of the strike price of 573, after which profits are capped at just over $2,100. Now let's take a look at the downside. The position begins to lose below the break-even price. And we can see here that losses accelerate up until the 540 strike put option kicks in, after which losses still occur but at a slower rate. And that is because the 100 shares of QQQ are uncovered. Now let's look at a variation that can be popular. I use it often. I'm going to highlight the 545 strike put. And what if I purchase 2 of those put options? What would that do to the profit and loss diagram? Well, it would cut our delta and it would limit our losses. So when we take a look at the profit and loss diagram here, we can see that losses would be limited to just under $4,000. And this profit and loss diagram looks very similar to a call vertical spread. So some food for thought there. The covered straddle is best understood not as better or worse than a covered call, but as a different synthetic expression of similar building blocks. A covered call combines stock with a short call. A short put is synthetically equivalent to a covered call, and when we put these together, a covered straddle is synthetically the same as either 2 covered calls or 2 uncovered short puts. None of these structures are inherently superior. They're simply a different way of arranging the same economic exposure. The choice between a covered call, an uncovered short put, or a covered straddle depends on more than just payoff diagrams. It depends on capital efficiency, option chain variables, portfolio construction, and trader preference and objectives. The important lesson is that option strategies are deeply interconnected through synthetics. By understanding these relationships, you can choose the structure that best fits your market outlook, risk tolerance, and portfolio design. If you're working through this as part of my Mastering Covered Call Writing course, this lesson is here to expand your toolkit. And if you're watching on YouTube, you'll find the full course link in the description below. This video is for educational purposes only and does not constitute investment, financial, or trading advice. No recommendations to buy or sell securities are being made. All examples are hypothetical and for illustration only. All investments carry risk, including the possible loss of principal. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Consult a qualified financial advisor before implementing any strategy and review your financial situation, risk tolerance, cost, fees, and tax implications. Options trading requires broker approval, and not all strategies are permitted in all account types. Returns shown are hypothetical and not guaranteed. Market conditions may change quickly, and results will vary based on market performance, timing, and execution. Read characteristics and risks of standardized options from your broker or at www.optionsclearing.com before trading options.